Bitcoin's BTC growing roadblock. The trendline from $126,000 limits gains. By Omkar Guidebull. AI boost. A potential breakout would confirm a bearish or bullish trend change. BTC's recovery attempts on Monday ran into a glass ceiling trendline from record highs. A potential breakout would confirm a bearish or bullish trend change. This is a technical analysis post by CoinDesk analyst and chartered market technician Omkar Guidebull. Bitcoin's BTC $87,682 late year attempt to regain poise ran into a glass ceiling Monday, forcing prices back below $88,000. That ceiling is defined by a descending trend line drawn from October's record high above $126,000, connecting the peaks of subsequent shallow recoveries, most notably the $116,400 high. This trendline swatted back attempts to establish a foothold above $90,000 on Monday, reinforcing the staircase down pattern that has plagued the largest cryptocurrency throughout the fourth quarter. By failing to clear this hurdle, BTC has printed another lower high, signaling a resurgence of sellers near the resistance line and stalling the momentum needed to challenge the six-figure mark. Consequently, the immediate outlook remains bearish as long as prices hold below the trendline. The latest rejection shifts focus toward the $84,000, $84,500 support zone, followed by the November low near $80,000. To revive the bullish outlook, BTC must overcome the trendline resistance. Such a breakout, especially against the backdrop of a sliding dollar index, could accelerate gains toward the $100,000 mark. MSTR liquidity buffer covers dividends and debt with no systemic risk through $2027. By James Van Straten. The company expanded its USD buffer runway beyond $2027, supporting dividends, and reduces refinancing risk ahead of the next Bitcoin halving. Strategy boosted its reserve to $2.2 billion, providing more than 2.5 years of runway to pay dividends and navigate a potential Bitcoin winter if prices follow the 4-year cycle. The enlarged cash position also gives the company the option of covering the September 2027 $1 billion convertible note put if needed, while leaving additional dividend headroom. Strategy MSTVAR, the largest Bitcoin BTC $87,720 holder among publicly traded companies, increased its dollar reserve to $2.2 billion. Giving the company a 2.5-year buffer to meet dividend obligations and the flexibility to navigate a potential Bitcoin winter if BTC prices follow the conventional 4-year market cycle. The company sold stock to add $748 million to the reserve on Monday. This cash cushion eases near-term liquidity pressure and supports operations through periods of heightened volatility. The reserve is earmarked for preferred stock dividend payments totaling some $824 million a year, according to the company dashboard, across the SDRK, SDRC, SDRF, SDRD and STRI series. The runway extends into the next Bitcoin BTC $87,720 halving, an event that cuts block rewards by 50% roughly every 4 years and is likely to next occur in April 2028. The roughly 32 months of cover supports uninterrupted payments through $2026, $2027, and into $2028. The first convertible note put date, when bondholders may force Strategy to repurchase their bonds, arrives in September 2027, with a $1 billion principal. Based on MSTR history of settling prior notes via share conversion, this would be the preferred option. If the share price remains below the $183 per share conversion threshold, Strategy will have sufficient cash. It currently trades near $165, around 12% below that level. At or above the conversion price, the notes would convert into equity, while prices below would require cash repayment. In addition, MSTR holds $671,268 BTC, offering further flexibility, as only a small portion of holdings would be needed if cash settlement were required. Jeff Walton, the chief risk officer at Strive, underscored the importance of what he calls the company's USD battery, noting that the current reserve is enough to fully address the September 2027 convertible put while still leaving an additional 15 months of preferred dividend coverage. MSTR shares are down roughly 45% year to date, trading near $163 per share. Minor capitulation is a contrarian signal, indicates renewed BTC price momentum, Van Eck says. By James Van Straten. Van Eck data shows declining Bitcoin mining activity has historically preceded strong returns in Bitcoin. Van Eck data shows that in the past 30 days Bitcoin's hash rate dropped by the most since April 2024. Hash rate declines are historically aligned with minor capitulation and markets closer to local bottoms than tops. According to Van Eck, periods of negative 90-day hash rate growth have delivered positive 180-day Bitcoin returns 77% of the time. Declining Bitcoin BTC $87,735 mining activity is often interpreted as a sign of network stress, reflecting weaker miner profitability, declining hash rate, and concerns over the economic sustainability of mining operations. It is commonly assumed to be bad for the Bitcoin price. Digital assets investment firm Van Eck, however, argues that periods of falling hash rate, the total computational power being used by miners to secure the Bitcoin network and process transactions, has historically functioned as a contrarian indicator, indicating improving price momentum rather than a signal of structural weakness. This dynamic is emerging as Bitcoin trades around $87,000, following a 36% peak-to-trough slide from the October's all-time high. Over the past 30 days, Bitcoin's network hash rate recorded its steepest decline since April 2024, as miners faced compressed margins from a weaker BTC price and that month's halving, an event that cuts block rewards by 50% roughly every 4 years, reducing new Bitcoin issuance. Van Eck notes that the shrinking hash rate when Bitcoin prices fall reflects minor capitulation, with inefficient or highly leveraged operators shutting down or selling Bitcoin, which contributes to sell-side spot pressure. In reality, hash rate declines tend to lag behind the price drops. According to Van Eck, the timing has historically placed the market closer to cyclical bottoms than tops. As higher-cost miners exit, lower difficulty adjustments occur, making it easier to mine Bitcoin and ensuring blocks are produced at a consistent pace. The resulting improved miner profitability then eases forced selling. The current price correction appears selective, Van Eck noted, with shutdowns concentrated among higher-cost or geopolitically exposed operations. Van Eck found that when the 90-day hash rate growth has been negative, Bitcoin has delivered positive 180-day forward returns 77% of the time, meaning the price performance over the following 6 months is higher than average than during periods of rising hash rate. The firm estimated that buying Bitcoin during sustained hash rate corrections has improved 180-day forward returns by roughly $2,400 basis points, reinforcing minor capitulation as one of Bitcoin's more durable contrarian signals. BTC News Analysis trails polar opposites, gold and copper, as the fear and AI trade lifts tangible assets. By Omkar Gadbul, gold and copper have outperformed other major assets this year, with gold rallying more than copper. Gold and copper have outperformed other major assets this year, with gold rallying more than copper. Bitcoin has underperformed, failing to attract both fear-driven and AI-driven investment, highlighting a shift towards tangible assets. The divergence in performance between gold and copper reflects market bets on both AI-driven growth and systemic financial fears. Investors seeking both safety and growth appear to have reached an unexpected consensus in 2025 that of Bitcoin BTC $87,735 failing to capture either trade. This sentiment is evident in a year-to-date comparison of major, widely tracked assets, including stocks, gold, the 10-year Treasury note, Bitcoin, industrial metals such as copper, and the dollar index. Gold, a traditional safe haven and inflation hedge, has rallied by 70% to a record high above $4,450 per ounce, outpacing every other major asset by a wide margin. Copper, widely considered a barometer of global economic health, is the second best performer with 35% gains, according to Source Trading View. The S&P 500 and Nasdaq have gained 17% and 21%, respectively, while the 10-year Treasury note has lost 9%, and Bitcoin BTC $87,735 is down 6%. The dollar index, which tracks the US dollar's exchange rate against a basket of fiat currencies, has dropped nearly 10%. The fact that polar opposites, gold, the ultimate fear hedge, and copper, an essential industrial anchor with AI links, are the top two performers, while BTC, the supposed digital gold and high-end tech, is down, suggests a shift in investor preference to tangible assets in the face of macro and political concerns and the AI boom. Early this year, haven demand, driven by macro and political issues and fiat debasement fears, coupled with the AI boom and a positively evolving regulatory outlook under the Trump presidency, were widely cited as ultra-bullish tailwinds for BTC. But that has not materialized. This is mainly due to the crypto community espousing BTC as digital gold rather than emerging tech, according to Marcus Thielen, founder of 10x Research. The emerging narrative of Bitcoin as digital gold has failed to fully convince Wall Street investors. Many crypto narratives marketed to institutional investors now resemble passive allocation stories, staking yield or long-term value preservation, rather than compelling use case-driven growth themes, Thielen told CoinDesk. However, there is little evidence that a new cohort of investors is meaningfully attracted to passive crypto exposures, limiting fresh capital inflows. He added, investors have snapped up gold as a haven asset amid rising fiscal concerns across the advanced world, tariff-led political tensions, fears of fiat debasement, and a potential threat to the Fed's independence. At the same time, investors looked past BTC as the high-end tech even as the AI boom delivered a massive windfall to a diverse set of assets, ranging from obvious tech stocks to the record-breaking rally in base metals like copper. The red metal has been driven higher by the overlapping trend of electrification, digital infrastructure, and geopolitical tension alongside slower supply growth. As Geopolitical Monitor recently noted, BTC lacks sovereign bid. Greg Magadini, director of derivatives at Amberdata, attributed BTC's dour performance to the absence of a sovereign bid for the cryptocurrency. Gold is the hard asset for global central banks and sovereign players. As sovereigns hedge their assets away from USDFX, gold has been the beneficiary, Magadini told CoinDesk. Bitcoin, on the other hand, is a more portable asset for individuals to hedge their FX debasement risk. He explained that BTC, being more speculative, has a demand base of higher risk tolerance investors, such as retail investors, hedge funds, and investment firms, rather than established sovereign entities. At least that's the case today, hence the large performance divergence in 2025, he said, adding the next leg higher in BTC needs sovereign adoption as ETF adoption, positive regulatory outlook and digital asset treasury narratives have been fully priced in. Gold's surge since 2023 has been partly driven by increased central bank buying, especially in Asian countries. According to World Gold Council, global central banks have purchased 254 tons of gold from January to October, building energy. While bears may see BTC's inability to catch a haven and AI bid as a sign of inherent weakness, that's not necessarily the case, according to Lewis Harland, portfolio manager at Re7 Capital, who said the cryptocurrency is building energy for a big rally. Gold's breakout is not a bearish signal for Bitcoin. Gold has been leading BTC by roughly 26 weeks, and its consolidation last summer matches Bitcoin's pause today. The metal's renewed strength reflects a market increasingly pricing in further currency debasement and fiscal strain into 2026, a backdrop that has consistently supported both assets, with Bitcoin historically responding with greater torque, Harlan said. He added that BTC's consolidation is therefore building energy rather than signaling weakness. The longer BTC sits tight, the more explosive the eventual move tends to be, positioning it to react strongly as the debasement trade accelerates, Harland quipped. Key takeaways for the global economy. Gold and copper are outperforming other assets, but gold's stronger rally over copper signals markets betting on two contradictory futures simultaneously, AI-driven growth copper versus fears of systemic failure from unsustainable fiscal debt gold. More importantly, gold's outperformance shows anxiety about the global financial system outweighing AI-led boom. While both gold and copper have hit record highs this year, the copper-to-gold ratio, a barometer for global economic health and risk sentiment, has dropped nearly 20% to lowest in over 2 decades, according to data source TradingView. Is a telltale sign of global economy in a late-cycle environment or fragile expansion driven by AI, but weighed down by fiscal, trade and geopolitical concerns. The most important takeaway is the flight to tangibility. When gold, copper hit record highs and the dollar index, treasury notes and stocks underperform, it means the market no longer trusts promises of paper fiat currencies or assets that are pure play on fiat liquidity. Bitcoin price news. BTC gives up early Monday gains, falling back below $88,000. By Helene Braun. Crypto continues to lose ground ahead of this week's record options expiration, while defensive positioning and thinning liquidity suggest caution into $2026. Bitcoin and crypto prices moved steadily lower in U.S. Monday afternoon trading. Over $28.5 billion in Bitcoin and Ether options are set to expire Friday on derivatives exchange Deribit, the largest expiry in its history. Bitcoin BTC $87,695 and other crypto assets again fell steadily through the U.S. session on Monday, with BTC sliding below $88,000 after earlier having climbed above $90,000 and ETH ducking back below $3,000. Some crypto-related stocks are still holding gains, led by Hut 8 HUT, which continues to rise following its deal last week for a 15-year AI data center lease with FluidStack. Shares are higher by 16% Monday, helped by a price target increase benchmarks Mark Palmer. Other names in the green include Coinbase Coin and Robinhood Hood, though both are well off session highs as crypto prices have pulled back. Strategy MSTR has swung from a 3% gain to a modest loss late in the day. Options expiration. The recent highly choppy price action between $85,000 and $90,000 comes ahead of Friday's record-setting $28.5 billion in BTC and ETH options expirations on crypto derivatives exchange Deribit. That amount represents more than half of Deribit's $52.2 billion in open interest, noted Jean-David Pequignot, the exchange's chief commercial officer. This year-end expiry marks the culmination of a year defined by institutional maturity and a shift from speculative cycles to a policy-driven supercycle, said Pequignot. At the center of the action, Pequignot continued, is Bitcoin's $96,000 max pain level, where option writers stand to benefit most. A notable $1.2 billion in open interest is clustered at the $85,000 strike in puts, which could pull spot prices lower if selling pressure builds. While midterm call spreads targeting $100,000, $125,000 remain in play, short-term protective puts have grown more expensive, he said. The skew between call and put pricing has dropped from recent highs but still indicates caution. Pequignot continued. Traders appear to be rolling defensive positions forward rather than closing them out, he said. According to Pequignot, there's been a shift from December $85,000, $70,000 puts into January $80,000, $75,000 put spreads. This suggests that while the immediate risk into year-end is being covered, traders remain wary of what's ahead. Bitcoin price news. BTC slips from day's highs during U.S. trading session. By Stephen Alfer, Christian Sandor. Bitcoin for the moment was unable to hold the $90,000 level reached prior to the U.S. market open. Crypto prices are slipping a little during the U.S. trading session as precious metals and stocks move higher. The AI trade remains strong, with Bitcoin miners who have pivoted business models moving sharply higher. Both gold and silver hit new records Monday, and one analyst said Bitcoin can't rally until those metals cool. Crypto bulls are again watching from the sidelines as the debasement trade continues and risk assets generally move broadly higher. During the U.S. trading session, the standout performer on Monday is gold, which has surged 2% to a new record high of $4,475 per ounce. Silver is higher by 1.6% and earlier hit its own fresh record at just below $70 per ounce. Just after the noon hour on the East Coast, the Nasdaq and S&P 500 are each ahead by 0.6%, and the US dollar index is lower by 0.3%, after racing above $90,000 during the Asian/European trading sessions. Bitcoin BTC $87,643 has pulled back closer to $89,000, still ahead over the past 24 hours, but continuing to underperform most major asset classes. Ether ETH $2,954, Solana SOL $124.07, and XRP $1.8924 also in the green on Monday, but they too have pulled back from highs hit prior to the U.S. opening for trade. AI trade remains strong. A check of crypto-related stocks shows those Bitcoin miners that have pivoted to business models to a focus on AI infrastructure and high-performance computing strongly outperforming on Monday. Helping the mood in that sector was a deal for Alphabet Goog to acquire AI infrastructure startup Intersect for $4.75 billion. The acquisition, said Alphabet, will enable more data center and generation capacity to come online faster, while accelerating energy development and innovation. Hut 8 HUT is leading gainers with an advance of 17.5%. Iron, Cipher Mining Cipher and Bitfarms posting gains of 5%, 10%. In other crypto sectors, Circle CRCL, Coinbase Coin, Bullish BLSH and Galaxy Digital GLXY are ahead 2%, 4%, and Bitcoin Treasury Bellwether Strategy MSTR is up just 0.3%. Bitcoin may not rally until gold cools. I reiterate the point that Bitcoin and crypto are unlikely to shine until this bull market in precious metals comes to a pause, by Tree analysts, led by Charlie Morris and Shahryar Ali, said in a Monday report. They pointed out that despite the current trends, Bitcoin have outperformed the metals sector over the past few years. However, silver with its ongoing parabolic rally has now nearly matched BTC's return over the past 8 years. Read more: Why Gold is Winning Over Bitcoin in 2025. Liquidity, Trade, and Trust. BlackRock names Bitcoin ETF a top $2025 theme despite price slump. By Helene Braun. The world's largest asset manager is promoting its underperforming Bitcoin fund over higher fee winners, signaling long-term commitment. BlackRock named its iShares Bitcoin Trust IBIT one of its top 3 investment themes for 2025. Despite Bitcoin falling more than 4% this year, IBIT has attracted over $25 billion in inflows since January, making it the 6th most popular ETF by new investment this year. The move signals BlackRock's conviction that Bitcoin belongs in diversified portfolios, even as traditional alternatives outperform. BlackRock named its iShares Bitcoin Trust IBIT exchange-traded fund ETF one of the top 3 investment themes for 2025. A striking move given Bitcoin's BTC $87,689 slide this year. The firm placed IBIT alongside 2 more traditional offerings: the iShares 0-3-month Treasury Bond ETF SCOV and the iShares Top 20 US Stocks ETF. Bitcoin has dropped more than 4% year-to-date, the first decline in 3 years, and IBIT has mirrored that performance. Even so, the ETF has seen strong investor interest. IBIT ranks 6th among all ETFs by 2025 inflows, pulling in over $25 billion since January. It's easy to frame this as BlackRock simply promoting its highest revenue product, said Nate Jersey, president of the ETF store, but I see it more as the firm doubling down on its conviction that Bitcoin belongs in diversified portfolios. Jersey noted that BlackRock has other ETFs, like the gold-focused IAU, that are outperforming IBIT and charge higher fees. Yet the firm is spotlighting a product that underperformed in 2025, a rare move in an industry that typically pushes its top-performing funds. If the objective were purely revenue generation, BlackRock has no shortage of ETFs with significantly higher fees that it could emphasize instead, he said. Asset managers are typically in the business of spotlighting underperforming products, particularly when they have a deep bench of outperforming alternatives they could highlight. The inclusion of IBIT as a top $2025 theme signals a long-term bet on the crypto asset by the world's largest asset manager. For investors who still see crypto as speculative or fringe, BlackRock's positioning of Bitcoin alongside cash and stocks may shift that perception. Bitcoin BTC News. Basis trade unwind sees Binance overtaking CME. By James Van Straten. Behind the move is a sharp narrowing in the profitability of the basis trade, in which traders attempt to capture a spread by buying spot Bitcoin while selling BTC futures. Binance has now become the largest venue for Bitcoin futures open interest with roughly $125,000 BTC, or about $11.2 billion in notional value. CME Bitcoin futures open interest has fallen to around $123,000 BTC, its lowest level since February 2024. Tightening spot futures spreads triggered basis trade unwinds and reduced institutional demand on CME. The CME has lost its place as the number one exchange for Bitcoin BTC $87,689 futures open interest OI. Binance has now overtaken CME as the largest venue by OI according to CoinGlass data, with Binance holding roughly $125,000 BTC $11.2 billion in notional value against the CMEs of $123,000 BTC $11 billion. CME OI started the year at $175,000 BTC, but that level has steadily fallen as the profitability of the basis trade, in which traders buy spot Bitcoin while simultaneously selling futures to capture the price premium between the two markets, has declined. Open interest on Binance, however, has remained steady throughout the year as it's the exchange more likely to be favored by retail punters betting on directional price movements. Just more than a year ago, CME OI reached a record $200,000 BTC as prices rally toward $100,000 following President Trump's election victory. At that time, the annualized basis rate surged to around 15%. Today, the CME that basis rate has compressed to roughly 5%, according to Velo data, reflecting diminishing returns for institutional basis traders. As spot and futures prices converge and market efficiency improves, arbitrage opportunities continue to shrink. CME had been the largest exchange for Bitcoin futures OI since November 2023, driven by institutional positioning ahead of the launch of spot Bitcoin ETFs in January 2024. That advantage, for the moment, appears to have faded. Hut 8 HUT News. Benchmark sees nearly 100% upside on stock after AI deal. By Wilcani. AI boost. Shares of the Bitcoin miner jumped higher last week on its $7 billion pact with Google-backed Fluidstack. Benchmark analyst Mark Palmer said Hut $7 billion, 15-year Fluidstack lease at Riverbend underscores its shift toward institutional-grade digital infrastructure. Google's payment backstop and expansion/renewal options could see the potential contract value rising to about $17.7 billion, according to Palmer. Palmer raised his Hut 8 price target to $85 from $78 and reiterated his buy rating on the stock. Wall Street broker Benchmark said Bitcoin miner Hut 8 HUT is using last week's Riverbend announcement to cement a shift from a crypto-first power owner into an institutional-grade digital infrastructure platform. Analyst Mark Palmer said the structure, counterparties and cash flow quality separate HUT's deal from the wave of recent AI data center agreements. He reiterated his buy rating on the stock and lifted his price target to $85 from $77, suggesting 93% upside from Friday's close of $44.12. Shares are higher by 2.8% per market to $45.34. Last Wednesday, HUT 8 signed a $7 billion, 15-year AI data center lease with FluidStack for its Riverbend data center in Louisiana. Shares gained as much as 20% following the news. The transaction combined superior deal economics relative to peer deals, long-dated, investment-grade backstopped cash flows, and multiple layers of embedded expansion optionality across three counterparties, Palmer said. Palmer's sum-of-the-parts SOT valuation includes the Riverbend lease value, potential future expansion capacity under a right of first offer granted to FluidStack, HUT 8's stake in American Bitcoin Corp, ABTC, and the Bitcoin held on its balance sheet as of Sept. 30. Palmer said a key point is timing. Management didn't rush to monetize power assets early in the AI infrastructure land grab, waiting instead for a configuration that met internal return hurdles and strategic criteria. He flagged the 15-year payment backstop from Google Goog as a meaningful de-risking feature that, in his view, lowers counterparty risk, while allowing HUT 8 to keep full economic ownership without warrants or equity sweeteners that have shown up in other deals. The report noted that 3 5-year renewal options could lift total contract value to about $17.7 billion. Benchmarks said it values the initial 245 megawatt MW Riverbend tranche at roughly $7.6 billion, reflecting contracted cash flows and the scarcity value of AI-ready power supported by an investment-grade backstop. Rival broker Cantor Fitzgerald last week raised its HUT 8 price target to $72 from $64, while Canaccord raised its target to $62 from $54. Read more. HUT 8 price target boosted at Cantor and Canaccord after Google backed AI deal. S&P 500's Santa tradition offers hope to battered Bitcoin BTC bulls. By James Van Straten. A time-honored Wall Street pattern could bring relief to battered BTC bulls as the year-end nears. Data show the S&P 500 tends to rally in the final week of December and first 2 trading days of January. A repeat of the historical pattern could bring relief to BTC, which is on track to register its worst fourth quarter since 2022. Bitcoin BTC $87,498 has experienced its toughest fourth quarter since 2022, but a time-honored Wall Street pattern could soon bring relief to battered BTC bulls. That pattern is S&P 500's tendency to chalk out a Santa rally, an upswing during the final 5 trading days of December and the first 2 of January. A repeat of this pattern could improve sentiment in the Bitcoin market. Bullish Santa seasonality. Since 2005, the S&P 500 has gained during the Santa Claus rally period 15 times and lost only 5 times, averaging 0.58% returns, according to data source The Market Stats. Going back to the 1950s, it has risen 77% of the time and never declined 3 years in a row during this window. The index dipped in the last 2 Santa periods. Taken together, these data sets mean that the S&P 500 is likely to chalk out a rally into the new year. For BTC, this bullish S&P 500 seasonality increasingly matters as the increasing institutional adoption via ETFs has tightened the link between digital assets and equities. So, a festive bid in stocks could spill over into Bitcoin and the wider crypto market. BTC's Santa Claus rally history is checkered since launch, with strong return to the tune of 33% and 46% in $2011 and $2016, respectively. Other years have been weaker, with declines of 14% in $2014 and 10% in $2021. Still, it averages 7.9% since $2011, with the market being quite small and dominated by OGs in early years. Gold, the star performer. According to the market stats, gold has been the top performer, delivering a 95% cumulative return over this period. Looking back to 2005, only $2,023 recorded a slight negative return. The strength has coincided with gold pushing to new all-time highs above $4,400 an ounce at press time, hinting at yet another positive Santa period. Broadly speaking, while gold is trading at all-time highs, the S&P 500 is just 1.5% away from its own record levels. Meanwhile, Bitcoin remains roughly 30% below its peak. Amplify's crypto-related STBQ and TKNQ ETFs come to market. By Francisco Rodriguez, AI Boost. The two funds, STBQ and TKNQ, each come with a 69 basis point expense ratio. Asset manager Amplify ETFs has brought to market two funds offering exposure to stablecoins and tokenized assets. STBQ focuses on stablecoin technology, while TKNQ focuses on tokenization technology, tracking specific market vector indexes. The funds each come with a 69 basis point expense ratio. Amplify ETFs, a fund provider with over $16 billion in assets under management, has brought to market two new ETFs that give investors targeted exposure to companies and cryptocurrencies behind stablecoins and tokenized assets. The Amplify Stablecoin Technology ETF STBQ offers exposure to payments companies, crypto infrastructure providers, and platforms facilitating stablecoin-based trading. It tracks the market vector Stablecoin Technology Index, which includes equities and crypto assets such as DeFi protocols and stablecoin-adjacent tokens. Amplify's website shows the fund currently has 24 holdings, the largest of which are spot crypto ETFs offering exposure to XRP, SOL, ETH, and Link. The Amplify Tokenization Technology ETF TKNQ focuses on businesses enabling the digitization of real-world assets and tracks the market vector tokenization Technology Index. TKNQ currently has 53 holdings, the largest of which are the same ETFs that offer exposure to spot cryptocurrency prices, along with several equities. Both funds carry a 69 basis point total expense ratio and are now trading on NYSE Arca. The timing of the offerings coincides with regulatory shifts. The U.S. Genius Act, signed in July, created a federal framework for stablecoins and also paved the way for institutions to settle tokenized assets using stablecoins by clarifying compliance and audit requirements. Of latest news, token slumps 18% over week, deeper than ETH, SOL, ADA. By Shoria Malwa. The move added to selling pressure that had already been building since the governance proposal moved to a snapshot vote. OV token has dropped 18% in the past week, making it the worst performer among the top 100 cryptocurrencies. The decline is likely linked to a governance dispute over control of OV's brand and public channels, despite founder Stani Kulichov purchasing $12.6 million worth of OV. The broader selling pressure continues. DeFi lending and borrowing protocol OV's governance fight is starting to cost investors wildly. The OV token is down about 18% over the past 7 days, making it the worst performer among the top 100 cryptocurrencies, even as Bitcoin, Ether and other large tokens trade flat to slightly higher. The sell-off stands out in a market that has otherwise stabilized, suggesting the pressure is specific to OV rather than a broader risk-off move. The drop follows a growing fight inside OV governance over who controls the protocol's brand, domains and public channels, as CoinDesk reported early last week. While the debate played out largely in forums and on social media last week, traders appear to be responding negatively to the uncertainty that has introduced around control, coordination and future decision-making. Data tracked by blockchain sleuth OnChain Lens shows large holders acting decisively. One large holder sold roughly $230,000 OV, worth nearly $35 million at current prices, over a short window on Monday, swapping the tokens for Ether derivatives and Bitcoin and triggering a sharp intraday drop of nearly 10%. The move added to selling pressure that had already been building since the governance proposal moved to a snapshot vote. At the same time, wallets tagged by on-chain explorers, Duo founder Stani Kilichov suggests he has been buying into the decline. Wallet data show Kilichov purchased roughly $12.6 million worth of OV over the past week at an average price of around $176, leaving him with an unrealized loss of about $2.2 million. As the token slid further, founder buying is often read as a confidence signal, but in this case it has not been enough to offset broader selling. The divergence between OV and the rest of the market is striking. Bitcoin has held near $90,000, while Ether, XRP and other majors have avoided similar drawdowns. That contrast suggests traders are not risking crypto broadly, but selectively reducing exposure to protocols facing internal uncertainty. Unlike macro-driven sell-offs, governance disputes create open-ended risk. There is no clear timeline for resolution, and outcomes can reshape how value flows through a protocol. In OV's case, the question of who controls the brand and front-end gateways cuts directly into how the DAO exerts power off-chain, an issue that does not lend itself to quick fixes. Bitcoin price news, BTC heads to its worst quarter since 2018, pressuring altcoins. By Shoria Malwa. Data from CoinGlass shows Bitcoin is down more than 22% so far in the fourth quarter, making 2025 one of the weakest year-end periods outside of major bear markets. Bitcoin's price is nearing $90,000, offering a short-term boost to the crypto market, but analysts remain cautious about a significant recovery. The total crypto market capitalization has surpassed $3 trillion, yet analysts warn that the rebound may be driven by exhaustion rather than renewed confidence. Bitcoin remains about 30% below its 2025 peak, with the market still vulnerable to sharp reversals, particularly during U.S. trading hours. Bitcoin's pushback toward near the $90,000 mark is giving the crypto market a short-term lift, but few analysts see it as a meaningful turning point after one of the weakest second halves in recent years. Major tokens remained range-bound in the past 24 hours, with XRP, Ether, Solana's SOL, Cardano's ADA and Doge $0.1295 rising as much as 2%. A decline in OV's OV continued as its governance tussle rages on, leaving it as the worst performing token with a 7% drop. Total crypto market capitalization has once again moved above $3 trillion, a psychologically important level that has acted as a key zone between buyers and sellers throughout the past month. While prices are higher on the day, analysts caution that the rebound reflects exhaustion rather than renewed conviction. Alex Kupsakevich, chief market analyst at FX Pro, said the market's recent strength is largely technical and driven by a low base after weeks of selling. The crypto market is making a new attempt at growth, but this is not yet a recovery, Kupsakevich said, noting that sentiment has improved only modestly. The market's fear and greed index has climbed to 25, suggesting traders may be stepping away from extreme pessimism, but not embracing risk. Bitcoin was trading near $88,000 in Asian morning hours Tuesday, pressing against the upper end of a range that has held since early last week. Kupsakevich warned that short-term momentum could prove misleading, especially given the broader context. Bitcoin remains roughly 30% below its 2025 peak and is trading below levels seen at the start of the year. Attempts to bring year-to-date performance back to zero are little consolation, he said in an email, adding that disappointment has replaced the optimism that dominated markets earlier this year. Seasonal patterns reinforce that caution. Data from CoinGlass shows Bitcoin is down more than 22% so far in the fourth quarter, making 2025 one of the weakest year-end periods outside of major bear markets. While the fourth quarter has historically produced some of Bitcoin's strongest rallies, it has also delivered sharp drawdowns during years marked by tightening liquidity and macro uncertainty. The market remains vulnerable to sharp reversals, particularly during U.S. trading hours. Recent sessions have repeatedly seen price gains from Asian and Europe sessions fade as North American markets open. Doge price news. Dogecoin breaks short-term support, eyes lower. By Sharia Malwa, CDE Analytics. Trading volume surged to 721 million tokens, indicating active repositioning rather than thin price movement. Dogecoin fell 1.8% as sellers regained control, with price drifting toward the lower end of its recent range. Trading volume surged to 721 million tokens, indicating active repositioning rather than thin price movement. Doge lost support near $0.1320, confirming a bearish short-term bias, as it failed to sustain gains above $0.135. Dogecoin edged lower during Sunday's session after failing to hold short-term support, with elevated volume suggesting sellers are regaining control as price drifts toward the lower end of its recent range. Market overview. Doge fell about 1.8% over the past 24 hours, sliding from an intraday high near $0.1341 to trade around $0.1323. The move followed a failed recovery attempt above $0.135, where selling pressure re-emerged and capped upside momentum. Trading activity picked up notably during the decline. Volume rose to roughly 721 million tokens around the session peak, about 150% above the 24-hour average, indicating active repositioning rather than thin, low liquidity price movement. Technical analysis. The key technical development was Doge loss of support near $0.1320, a level that had held during several prior pullbacks. Once that area gave way, price drifted toward session lows with limited follow-through buying. On intraday charts, Doge also slipped below the lower boundary of a short-term ascending channel, confirming a shift away from the modest recovery structure that had formed late last week. The rejection near $0.1352 established a lower high, reinforcing the bearish short-term bias. Price action summary. Doge failed to sustain gains above $0.135, meeting selling interest at resistance. Volume expanded sharply during the rejection, pointing to distribution. Price slipped below $0.1320, a level that had acted as near-term support. Late session trade stabilized near $0.1323, but without a strong rebound. Overall, price action reflected controlled selling rather than panic, though momentum remains tilted lower. What traders should watch, with $0.1320 now acting as overhead resistance, attention shifts to whether Doge can stabilize above the next demand area near $0.1280, $0.1290. That zone aligns with prior consolidation and could attract dip buying interest if selling pressure eases. On the upside, Doge would need to reclaim $0.1320 and then $0.1350 to neutralize the current bearish structure. Until then, rallies are likely to face supply from traders looking to exit positions on strength. For now, Doge remains in a fragile technical position, with price action suggesting a consolidation to lower pattern rather than a confirmed reversal. XRP price news today. Struggles near $1.90 as mixed technical signals emerge. By Sharia Malwa, CD Analytics. Price action remained contained within a relatively tight range, with total volatility of about 2.7%, reflecting indecision rather than capitulation. XRP declined 0.9% over the past 24 hours, failing to break resistance near $1.95 and stabilizing around $1.90. Elevated trading volume indicated active selling pressure, with price briefly dipping below $1.90 before rebounding. Traders are monitoring key support at $1.89 and resistance near $1.95 for signs of trend direction. XRP drifted lower over the past 24 hours as a recovery attempt from weekend low stalled below key resistance, leaving traders weighing early stabilization signals against a still fragile technical structure. Market overview. XRP slipped about 0.9% over the 24-hour period ending Dec. 23, sliding from roughly $1.92 to $1.90, after failing to sustain a push toward resistance near $1.95. Price action remained contained within a relatively tight range, with total volatility of about 2.7%, reflecting indecision rather than capitulation. Selling pressure intensified late Sunday as XRP was rejected near $1.93, triggering a move back below the psychological $1.90 level. That rejection reinforced a pattern of lower highs that has defined recent sessions, keeping short-term momentum tilted to the downside. Technical analysis. The heaviest trading activity occurred around 22:00 UTC on Dec 22, when volumes surged to roughly 74.5 million tokens, about 68% above the 24-hour average. The spike coincided with a sharp rejection from resistance near $1.93, confirming active selling rather than passive drift. Following the breakdown, XRP briefly dipped to the $1.89 area, where buyers stepped in to stabilize price. On lower timeframes, the decline showed signs of slowing, with consecutive candles holding above the session low near $1.893. A short-term rebound followed, pushing price back toward the $1.90-$1.91 zone, though without decisive follow-through. Price action summary. XRP failed to sustain gains above $1.93 after testing resistance near $1.95. Elevated volume accompanied the rejection, signaling distribution at higher levels. Price briefly broke below $1.90 before stabilizing near $1.89-$1.90. Subsequent rebound attempts lacked momentum, keeping the range intact. Overall, the session resolved into consolidation rather than continuation in either direction. What traders should watch? Technical signals remain mixed. Some analysts point to emerging bullish divergences on momentum indicators, suggesting selling pressure may be weakening near recent lows. Others caution that XRP remains below key moving averages on higher timeframes, a setup that has historically preceded deeper corrective phases when sustained. Key levels now frame the near-term outlook. Support. Initial support sits near $1.89, followed by deeper levels around $1.87 and $1.77. Resistance. Overhead supply remains concentrated near $1.95-$1.98, with moving averages reinforcing that zone. Bias. A sustained reclaim of $1.93 would be needed to improve short-term structure, while a clean break below $1.89 would reopen downside risk. Until one of those levels gives way, XRP appears stuck in a consolidation phase, with traders watching for clearer confirmation of either trend exhaustion or renewed downside pressure. BNB lags market despite its break above $860 as scrutiny of Binance grows. By CD Analytics, Francisco Rodriguez. The underperformance came over an investigation alleging Binance failed to stop suspicious transactions, despite agreeing to pay $4.3 billion to settle a U.S. criminal case. The price of BNB rose 1.7% in 24 hours, breaking past the $860 resistance level, despite underperforming the wider cryptocurrency market. The underperformance came amid an FT investigation alleging Binance failed to stop suspicious transactions, despite agreeing to pay $4.3 billion to settle a U.S. criminal case in 2023. BNB is currently 32% below its all-time high of $1,360, while other exchange tokens like KCS and LEO have shown more resilient performance, down far less from their all-time highs. The price of BNB moved up over 1.7% in the last 24 hours amid a cryptocurrency market rise that saw the wider CoinDesk 20 CD20 index move up 2.2% in the same period. The price broke past the $860 resistance level that had capped recent rallies and briefly touched $868 before seeing a slight pullback. BNB underperformed the wider cryptocurrency market at a time in which the Financial Times published an investigation saying Binance failed to stop hundreds of millions of dollars of cryptocurrency from flowing through suspicious accounts. These failures, it says, came even after it agreed to pay $4.3 billion to settle a U.S. criminal case. Trading volume jumped 192% above the daily average according to CoinDesk Research's technical analysis data model, with several peaks seen as the price approached support levels. 3 separate bursts of volume above confirmed momentum behind the move and helped establish new support around $856, $858. The hourly chart revealed a V-shaped recovery after an early dip to $851, with buyers stepping in aggressively and pushing prices back above $863. From there, an ascending triangle formed between $864.00 and $865.80, a pattern often linked with bullish continuation. BNB remains 32% below its all-time high of $1,360. Other exchange tokens, KCS and Leo, are down far less from their all-time highs, showing resilient performance according to Odd Crypto Quant data. Disclaimer: parts of this article were generated with the assistance from AI tools and reviewed by our editorial team to ensure accuracy and adherence to our standards. For more information, see CoinDesk's full AI policy. Coinbase Coin agrees to buy the clearing company to deepen prediction markets push. By Francisco Rodriguez. The deal brings in a team with specialized experience building event-based trading systems, including veterans from Polymarket and Kalshi. Coinbase is acquiring the clearing company, a startup with experience in prediction markets, to help grow its newly introduced platform. The deal brings in a team with specialized experience building event-based trading systems, including veterans from Polymarket and Kalshi. The acquisition is part of Coinbase's plan to become an everything exchange, offering a wide range of trading options, including novel cryptocurrencies, perpetual futures contracts, stocks, and prediction markets. Coinbase Coin said it agreed to buy the clearing company to help grow its newly launched prediction market as part of the crypto exchange's plan to become an all-in-one platform for trading everything. San Francisco-based The Clearing Company is a startup led by Tony Gemail, who has worked extensively in the industry, including as the head of growth at prediction market Kalshi. Terms of the deal were not disclosed. The transaction, which is expected to close in January, comes as prediction markets pick up steam, with weekly notional volume now topping $4 billion according to Dune Analytics data. Last week, Coinbase started letting users trade on the outcomes of real-world events in partnership with Kalshi. The events range from political elections and economic reports to cultural moments and sports. Coinbase said the deal will bring in a team with specialized experience building and scaling event-based trading systems. It includes veterans at Polymarket, a blockchain-based platform, as well as a former chief compliance officer at Kalshi. Last week, the exchange said it plans to expand the functionality available on its platform to also include novel cryptocurrencies, perpetual futures contracts, and stocks, as well as prediction markets. It is using the initiative to position itself as the everything exchange. The company's rivals, including Robinhood, Kraken, and Gemini, have already started launching equity trading and predictions markets to their users. In August, the clearing company raised $15 million in a seed round led by Union Square Ventures and in which Coinbase Ventures participated. Last month, it applied for license to run a clearinghouse from the Commodity Futures Trading Commission CFTC. Raised $15 million in a seed round led by Union Square Ventures and in which Coinbase Ventures participated. Last month, it applied for a license to run a clearinghouse from the Commodity Futures Trading Commission CFTC. Read more. Prediction markets beat Wall Street in forecasting inflation, Kalshi says. Ethereum Treasury News. ETH Zills ETH sells $74.5 million in ETH to pair liabilities. By Christian Sandor. This is the second time the firm sold a part of its crypto treasury, following a $40 million Ether sale in October to buy back its stock. Zilla ETHs sold $24,291 Ether ETH for roughly $74.5 million to redeem senior secured convertible notes. After this second sale of digital assets, the company, formed with the intention of holding ETH, still owns approximately $69,800 ETH worth more than $200 million. Many digital asset treasury firms are facing pressure following stock price plunges and are shifting focus from accumulation to managing liabilities. It's the digital asset treasury bubble in reverse, as companies once hell-bent on accumulating crypto on their balance sheets turn to digital asset sales in an effort to either prop plunging stock prices or reduce outstanding debt. Zilla ETHs, a Nasdaq-listed firm focused on building a reserve of the second-largest cryptocurrency, Ether ETH $2,963, late Friday said it sold $74.5 million worth of tokens from its treasury. It's the company's second such sale of ETH holdings. The funds from this latest sale are intended to redeem outstanding senior secured convertible notes under the terms of an agreement signed earlier this month, according to a Friday regulatory filing. The company sold $24,291 ETH at an average price of $3,068, bringing company holdings down to roughly $69,800 ETH worth more than $200 million. ETH's shares were lower by 4% on Monday and have lost roughly 96% from their August highs. The latest maneuver underscores the ongoing pressure digital asset treasuries face. Many public firms that raised funds to buy digital assets earlier this year are now trading below the net asset value (NAV) of their holdings, as their stock prices have slumped far more than the value of their underlying crypto. That discount has made it harder, if not impossible, to raise capital to accumulate additional crypto assets, leading some firms to shift to managing liabilities by instead dipping into their crypto reserves. Zilla earlier in the fourth quarter unloaded $40 million in ETH, using proceeds then to fund share repurchases. The stock, though, has continued to fall, currently trading below $7 versus the $20 area when the October repurchase was announced. The company said it may continue to raise capital through selling ETH or equity offerings as it works to advance its business plans. Read more. Bitmine buys $300 million in Ether, crossing 4 million ETH treasury milestone. Parity Act would exempt small crypto buys and apply wash sale rules. By Olivier Acuna. The bipartisan bill would modernize crypto taxation by deferring staking rewards, exempting stablecoin gains under $200, and tightening reporting rules. A bipartisan bill in the U.S. House aims to modernize tax rules for digital assets, addressing issues like excessive taxation and tax abuse. The Parity Act proposes tax exemptions for stablecoins, deferral options for staking rewards, and aligns digital assets with traditional securities. The bill includes measures to prevent tax loss harvesting in crypto and offers tax benefits to foreign investors trading through U.S. brokers. A bipartisan duo in the U.S. House of Representatives is circulating a draft bill that would streamline tax rules for investors, traders, and developers by explaining how they would handle reporting their taxes on staking, low-value transactions, and wash sales. Representatives Max Miller of Ohio and Stephen Horsford of Nevada unveiled the Digital Asset Protection, Accountability, Regulation, Innovation, Taxation, and Yields Parity Act on December 20. The proposal aims to modernize the Internal Revenue Code of $1,986 by eliminating excessive taxation on everyday crypto transactions, addressing phantom income, and closing gaps that lawmakers say invite tax abuse. America's tax code has failed to keep pace with modern financial technology, said Miller. This bipartisan legislation brings clarity, parity, fairness, and common sense to the taxation of digital assets. It protects consumers making everyday purchases, ensures the rules are clear for innovators and investors, and strengthens compliance so everyone plays by the same rules. The Parity Act includes targeted tax exemptions for regulated stablecoins, optional tax deferral on staking and mining rewards, and new rules aligning digital assets more closely with traditional securities and commodities. It would exempt capital gains tax on low-value stablecoin transactions under $200, provided the tokens are dollar-pegged, actively traded and issued by a federally regulated entity. The bill would also apply long-standing wash sale rules to crypto, preventing traders from harvesting tax losses while keeping similar positions. Additionally, it proposes a mark-to-market accounting election for active digital asset traders, requiring annual recognition of gains and losses based on fair market value. A separate provision applies the constructive sale doctrine to crypto, targeting derivative-based hedging strategies that defer tax indefinitely. Other measures include granting non-recognition treatment to certain digital asset loans, excluding NFTs and thinly traded tokens, and extending tax benefits to foreign investors who trade crypto through U.S. brokers. While most provisions would take effect upon enactment, the stablecoin exemption would begin in tax years starting after Dec. 31, 2025. Today, even the smallest crypto transaction can trigger tax calculation, while other areas of the law lack clarity and invite abuse, said Horsford. Our discussion draft of the Digital Asset Parity Act takes a targeted approach that provides an even playing field for consumers and businesses alike to benefit from this new form of payment. CoinDesk wins a Polk Award, one of journalism's top prizes, for explosive FTX coverage. By Nick Baker, Mark Hochstein. 3 stories were honored, including Ian Allison's scoop that led to Sam Bankman-Fried's $32 billion crypto empire collapsing in days. CoinDesk journalists won a George Polk Award for the scoop that led to Sam Bankman-Fried's $32 billion cryptocurrency empire collapsing in days, and for 2 explosive follow-up stories. This is the news organization's first major journalism award. CoinDesk's Ian Allison and Tracy Wang won the prize for financial reporting, according to a statement Monday. Previous winners in that category include the Wall Street Journal's series on the Ranos and the International Consortium of Investigative Journalists' stories on the so-called Panama Papers, created in $1,949 by Long Island University to honor murdered war correspondent George Polk. The Polk Awards are among the most prestigious prizes in journalism and emphasize investigative work that is original, resourceful, and thought-provoking. The trio of honored CoinDesk stories exemplified those qualities. This is an important milestone, not only for CoinDesk, but for crypto media generally, said Michael Casey, CoinDesk's chief content officer. Despite all that Ian and Tracy's incredible reporting exposed, and the fallout that it triggered, the crypto industry will continue to have a significant impact on the world. It's vital that it be covered with a kind of probing, well-informed, professional journalism embodied by these 2 reporters and their attentive, dedicated editors. The industry-shaking Nov. 2 story from Allison, a senior reporter, resulted from a source's tip that Sam Bankman-Fried's closely held trading firm, Alameda Research, was on shakier financial footing than was generally known. Allison got to work finding evidence and nailed it by obtaining the company's balance sheet, which was not a public document. It showed that a significant portion of Alameda's billions of dollars in assets was secretly made up of FTT, a sort of digital monopoly money issued by Bankman-Fried's better-known FTX crypto exchange. The resulting story raised concerns about the stability of Alameda and FTX, and called into question Bankman-Fried's image as a white knight capable of backstopping struggling companies, and as an adult in the room in a field notorious for fly-by-night outfits and scammers. The article debuted in a world where FTX was fast becoming a household name thanks to a marketing blitz featuring Larry David, Tom Brady, and Gisele Bündchen. Within days, the price of FTT plummeted and Bankman-Fried agreed to a bailout from rival exchange, Binance. Almost immediately, Binance got cold feet, as revealed by another poll-winning scoop from Allison that instantly drove down prices in the entire crypto market. Hours later, Binance confirmed it was backing out of the deal. Wang, a deputy managing editor, provided the third CoinDesk scoop honored by the Polk Awards. a story revealing that Bankman-Fried and 9 co-workers lived together in a luxury Bahamas condominium and at times dated each other while running his companies, including the fact that Bankman-Fried and Alameda CEO Caroline Ellison had once been a couple. The piece raised concerns about nepotism, secrecy, and conflicts of interest, previewing the tone of a scathing report issued soon after on FTX's extremely lax administrative procedures. 9 days after Allison's initial story, Bankman-Fried's companies filed for bankruptcy protection. Not long after, Bankman-Fried was arrested and the U.S. Congress held hearings. There is little precedent in journalism history for a story that made such an impact and did it so quickly. The fallout reverberated throughout the crypto industry and even hurt CoinDesk's corporate sibling Genesis and parent company Digital Currency Group, underscoring CoinDesk's editorial independence and dedication to telling important stories. More than $2,000 news stories have credited CoinDesk for setting off the chain of events, including pieces from high-profile publications like the New York Times, the Wall Street Journal, Bloomberg, the Financial Times, The Verge, New York Magazine, CNN, and NPR's Planet Money podcast. As great an honor as the George Polk Award is, I gotta say Ian and Tracy totally deserve it for some of the best journalism it's been my pleasure to witness, said Kevin Reynolds, CoinDesk's editor-in-chief. They and the work they did are totally awesome. I also need to give a shout-out to Deputy Editor-in-Chief Nick Baker, who was a key partner to Ian and Tracy in bringing these market-shaking stories to life, and to the rest of the CoinDesk news team, which kicked butt on covering the maelstrom that resulted from Ian and Tracy's incredible scoops. Read more. CoinDesk's major award is a huge moment for us and crypto media generally. $2025 was defined by a stark divergence. Structural progress collided with stagnant price action. Institutional milestones were reached and TVL increased across most major ecosystems, yet the majority of large-cap Layer 1 tokens finished the year with negative or flat returns. This report analyzes the structural decoupling between network usage and token performance. We examined 10 major blockchain ecosystems, exploring protocol versus application revenues, key ecosystem narratives, mechanics driving institutional adoption, and the trends to watch as we head into 2026. Bitcoin price analysis. Traders brace for U.S. session as BTC climbs above $90,000. By Shaurya Malwa. Futures open interest rose steadily as BTC pushed higher, climbing toward $60 billion across major venues. Bitcoin's price rose from $88,000 to over $90,000 during Asian and European trading hours on Monday, but caution is building as U.S. markets prepare to open. The U.S. trading session is crucial for determining if Bitcoin's rallies can sustain, as previous gains have shown a distinct pattern of reversing. Rising open interest in Bitcoin futures suggests increased leverage, raising the stakes for whether the rally is driven by spot demand or speculative futures. Bitcoin BTC $87,629 rose from $88,000 in Asian hours to above $90,000 in European afternoon hours on Monday, but reasons for caution linger as U.S. markets take the baton. BTC has tended to find early support during Asia and Europe hours in recent weeks, only to fade once U.S. investors return to the market. That dynamic has made the U.S. session a key test for whether rallies can stick. Previous pushes above major levels, including $90,000, have often reversed during New York hours as hedges are added and profits are taken, often leading to hundreds of millions in liquidations amid the seesaw trading. Derivatives positioning shows risk building alongside the price. Bitcoin futures open interest rose steadily as BTC pushed higher on Monday, climbing toward $60 billion across major venues, according to CoinGlass data. Binance, CME, and Bybit all saw notable increases, suggesting fresh leverage entering the market rather than short covering alone. That dynamic has become familiar in recent weeks of price strength, just outside U.S. hours, followed by heavier selling once American traders come online. The concern now is not the breakout itself, but whether the rally is supported by spot demand or increasingly dependent on leveraged futures. Open interest rising alongside price does not automatically signal trouble, but it does raise the stakes. If the move holds, leverage can amplify upside. If momentum stalls, Crowded positioning leaves the market vulnerable to fast pullbacks as long positions unwind. The risk for bulls is that a failure to hold $90,000 during U.S. hours could reinforce the market's recent pattern of lower highs and quick pullbacks. A sustained move above the level, by contrast, would mark a break from the sell the open behavior that has defined much of December. Bitcoin Quantum Computing Warning, BTC upgrade against threat might take 10 years. By Shaurya Mulwa. Even if quantum machines capable of breaking Bitcoin's cryptography are decades away, the work required to update software, infrastructure and user behavior would be measured in years, not months. Bitcoin developers are preparing for the potential threat of quantum computing, which could take 5 to 10 years to address if necessary. The shift in focus is from the immediacy of quantum threats to the logistics of updating Bitcoin's infrastructure and user behavior. Bitcoin's conservative governance model complicates large-scale transitions, requiring significant coordination for any move toward quantum-resistant cryptography. Some Bitcoin developers are no longer arguing about whether quantum computing will break the network, but letting onlookers know how long it would take to prepare if it ever did. That shift was crystallized this week by longtime Bitcoin developer James Lopp, who said that while quantum computers are unlikely to threaten Bitcoin, any meaningful defensive changes could take much longer than many assume. No, quantum computers won't break Bitcoin in the near future, Lopp posted. We'll keep observing their evolution. Yet, making thoughtful changes to the protocol and an unprecedented migration of funds could easily take 5 to 10 years. The discussion matters because Bitcoin's value increasingly depends on long-term confidence. As more institutional capital treats Bitcoin as a multi-year holding, even distant technical risks can influence allocation decisions and shape how markets price uncertainty, as CoinDesk reported on Saturday. Lopp's point was less about whether Bitcoin survives quantum computing, and more about how much time the network would actually need if it ever had to respond. His comment reframed the debate away from immediacy and toward logistics. Even if quantum machines capable of breaking Bitcoin's cryptography are decades away, the work required to update software, infrastructure and user behavior would be measured in years, not months, and that's a significant amount of time for quantum computing research, funding and hardware capabilities to advance in ways that could compress timelines faster than expected. Bitcoin relies on elliptic curve cryptography to secure wallets and authorize transactions. In theory, sufficiently powerful quantum computers running Shor's algorithm could derive private keys from exposed public keys, putting older address formats at risk. The network would not collapse overnight, but coins that have already revealed their public keys could become vulnerable. Bitcoin changes take time. Bitcoin's conservative governance model, one of its core strengths, also makes large-scale transitions difficult. Any move toward quantum-resistant cryptography would require new address formats, wallet upgrades, exchange support, and, crucially, user action. Billions of dollars worth of Bitcoin would need to be voluntarily moved. That reality helps explain why some investors remain uneasy. Large allocators do not need quantum computers to exist tomorrow to care about the issue today. For institutions holding Bitcoin as a long-duration asset, the question is whether the network can coordinate major changes before they are forced. Proposals such as BIP 360 aim to address that gap by introducing quantum-resistant address types and allowing a gradual transition over time. But no timeline has been set, and no migration has begun. For now, quantum risk remains theoretical. Lopp's point is not that Bitcoin is in danger, it is that preparation, if it ever becomes necessary, will take longer than the debate itself. Bitcoin and Ether options worth $27 billion set for year-end reset. By Omkar Gadbul, the expiration involves over 50% of derivatives total open interest, with a bullish bias indicated by a put-call ratio of 0.38. The crypto market is preparing for the expiry of $27 billion of Bitcoin and Ether options on derivative on Friday. The expiration involves over 50% of derivatives total open interest, with a bullish bias indicated by call options outnumbering puts by almost 3 to 1. The market's panic has subsided, and the looming expiry is likely to be much orderly than last year, according to Deribit. The crypto market is bracing for a massive structural reset on Friday, with billions of dollars worth of Bitcoin BTC $87,616 and Ether ETH $2,944 options set to expire on Deribit. This colossal Boxing Day event, named for the holiday observed in many countries on deck 26, will see $23.6 billion in Bitcoin options and $3.8 billion in Ether options expire, that is, they stop trading and are settled. These figures reflect the dollar values of active options contracts at press time, with each contract representing 1 BTC or 1 ETH. According to Deribit, the expiry, which affects more than 50% of the total open interest on the centralized exchange, is characterized by bullish positioning. The max pain level sits near $96,000, while a put-call ratio of 0.38 reflects positioning skewed toward calls and a bullish bias. Sidra Farik, Deribit's global head of retail sales and business development, said in an interview on Telegram, the max pain price is the level where options buyers stand to lose the most money and options sellers, usually big institutions and market makers, make the most profit. Options are derivative contracts that give the purchaser the right, but not the obligation, to buy or sell the underlying asset at a predetermined price at a later date. A call option buyer is implicitly bullish on the market, while a put buyer is bearish, looking to hedge against or profit from a potential price drop in the underlying asset. The max pain magnet. Max pain is one of the most watched figures as options expiry nears. Because of the profit/loss implications for the two sides of the contract, some observers suggest that it creates a tug-of-war between professional traders adjusting their hedges, often moving the spot price toward the max pain level as the clock ticks down. In essence, supporters of the theory suggest it implies Bitcoin could rise to $96,000 and Ether to $3,100 by expiry. Still, the max pain hypothesis remains a contentious and debated concept within the broader crypto derivatives landscape, with many market participants suggesting it has little effect on prices. Bullish bias meets holiday lull. As for the put-call ratio, it indicates that for every 100 call options in play, there are only 38 puts. It indicates just how bullish traders have been throughout the year, chasing bullish exposure via call options. At the time of writing, most open interest was concentrated in calls at strikes ranging from $100,000 to $116,000. Meanwhile, the $85,000 put was the most popular downside bet. Large expiries like this one typically breed volatility as traders scramble to close trades or rollover, that is, shift to new expiries. According to Farik, some put options at strikes $70,000 to $85,000 are being rolled into January expiries. The decision to let December put open interest expire or extend them will determine whether downside risk is due to year-end risk or a structural risk reset, Farik said. Still, the impending settlement could be more orderly, she added. The huge expiry comes on Boxing Day. Volatility remains contained. Deribit's BTC devol around 45, and while overall activity remains high and upside exposure dominates, holiday season thinned liquidity and ongoing macro uncertainty temper directional conviction, Farik noted. The devol is the index representing Bitcoin's annualized 30-day implied or expected price turbulence. This options-based metric has pulled back to 45% from 63% on Nov 21 when BTC tanked to nearly $80,000 on some exchanges. The decline indicates that the market's sense of panic is fading, and traders don't necessarily see a outsized volatility due to expiry. Bullish Bitcoin BTC plays on Bitfinex swell to highest since early 2024. By James Van Straten. Margin long positions continue to climb, signaling strong conviction despite Bitcoin's weakness. Bitfinex margin longs have risen to roughly $72,700 BTC, up from around $55,000 BTC since October, matching levels seen just before Bitcoin's March 2024 peak near $73,000. Historically, major Bitcoin bottoms have aligned with Bitfinex whales reducing long exposure, a signal that has not yet appeared. The number of bullish Bitcoin BTC $87,694 bets raised with borrowed funds continues to rise on Bitfinex, one of the oldest cryptocurrency exchanges. The so-called margin long positions have risen to roughly $72,700 BTC, the highest since February 2024. According to data source TradingView, the tally has increased from around $55,000 BTC since October, indicating a persistent dip buying operation throughout the price slide to $89,000 from over $126,000. At one point in November, prices hit a low of nearly $80,000 on some exchanges. The buildup in long exposure highlights confidence among traders, even as Bitcoin is on track for 3 consecutive monthly declines, a pattern not seen since mid-2022 during the bear market. Interestingly, the number of bullish margin long bets on Bitfinex has historically been a contrary indicator for the market. These positions typically peak when the market is struggling and then dried up, just as a new uptrend begins to take hold. In past cycles, a sustained decline in margin longs has coincided with market bottoms or the early stages of a recovery. This pattern was strikingly evident during the August 2024 yen carry trade unwind, when Bitcoin bottomed out at around $49,000, coinciding with a sharp reduction in leveraged bets. A similar dynamic unfolded during the tariff-driven sell-off in April 2025, as prices dipped toward $75,000. The decline in margin longs once again signaled that the weakest hands had been shaken out, setting the stage for a subsequent bounce. For now, the continued increase in leverage suggests that BTC prices are yet to find a bottom. Bitcoin faces uncertain 2026 outlook. $250,000 by end of 2027. Galaxy Digital's Alex Thorne. By Siamak Masnavi, AI Boost. Galaxy Digital's Alex Thorne says options, signals, and macro risks make Bitcoin hard to call in 2026, while maintaining a $250,000 target for the end of 2027. Galaxy Research, the research arm of Galaxy Digital GLXY, says overlapping macroeconomic and market risks make Bitcoin unusually difficult to forecast in 2026. The firm says that options pricing and volatility trends indicate that Bitcoin is maturing into a more macro-like asset, rather than a high-growth trade. Galaxy maintains a long-term bullish outlook, projecting that Bitcoin could reach $250,000 by the end of 2027. Galaxy Digital's head of firm-wide research, Alice Thorne, says 2026 may be one of the most difficult years to forecast for Bitcoin BTC $87,464, even as the firm maintains a bullish long-term outlook. In a Dec. 21 post on X, Thorne said the coming year is too chaotic to predict, pointing to a mix of macro uncertainty, political risk and uneven crypto market momentum. Thorne said the comments were based on Galaxy Research's Dec. 18 report, 26 crypto, Bitcoin, DeFi, and AI predictions for 2026, which outlines the firm's expectations for crypto markets and institutional adoption. At the time of writing, Thorne said the broader crypto market was already deep in a bear phase, with Bitcoin struggling to re-establish sustained bullish momentum. Until the asset decisively trades above the $100,000 to $105,000 range, he said, downside risk remains. What options markets are signaling? Derivatives markets underscore that uncertainty. According to Thorne, Bitcoin options pricing implies roughly equal probabilities of sharply different outcomes next year, with traders assigning similar odds to prices near $70,000 or $130,000 by mid-2026 and near $50,000 or $250,000 by year-end. Options markets are widely used by institutional investors to hedge future price risk, and such wide ranges suggest professionals are preparing for large price swings rather than a clear directional trend. Signs of structural maturity. At the same time, Thorne pointed to signs of structural change beneath the surface. He said that long-term Bitcoin volatility, a measure of how widely prices fluctuate over extended periods, has been declining. He attributed part of that shift to the growth of institutional strategies such as options overwriting and yield generation programs, which tend to dampen extreme price moves. That evolution is also visible in Bitcoin's volatility smile, which describes how option prices vary across strike levels. Thorne said that downside protection is now priced more expensively than upside exposure, a pattern more commonly seen in mature macro assets, such as equities or commodities, than in high-growth markets. Why a quiet year may not matter. For Thorne, those signals help explain why a potentially range-bound or boring $2026 would not undermine Bitcoin's longer-term case. Even if prices drift lower or approach long-term technical levels such as the 200-week moving average, he expects institutional adoption and market maturation to continue. Beyond short-term price action, Galaxy's longer-term conviction rests on deeper institutional integration. In its Deck 18 report, the firm stated that a major asset allocation platform could incorporate Bitcoin into standard model portfolios, a move that would embed the asset into default investment strategies rather than through discretionary trades. Such inclusion would direct persistent flows into Bitcoin regardless of market cycles, reinforcing Galaxy's view that structural adoption, rather than near-term volatility, will shape outcomes into $2027 and beyond. Thorne believes that expanding institutional access, potential easing of monetary conditions, and demand for alternatives to fiat currencies could position Bitcoin to follow gold's path as a hedge against monetary debasement. Galaxy predicts that the flagship cryptocurrency could reach $250,000 by the end of 2027. Bitcoin BTC News. Need more evidence before lowering rates further, says Fed's Hammock. By Stephen Alfer. My base case is that we can stay here for some period of time, Cleveland Fed President Beth Hammack told the WSJ. Cleveland Fed President Beth Hammack, who will be the voter on the central bank's policymaking FOMC in 2026, says interest rates need to remain on hold for several months. She threw shade on last week's surprisingly soft CPI report, noting data collection distortions created by the government shutdown. Other things being equal, Bitcoin would typically benefit from easier Fed monetary policy, but that hasn't at all been the case in 2025. It's no secret that Cleveland Fed President Beth Hammack has staked out a spot as perhaps the most hawkish member of the U.S. Federal Reserve since her appointment in 2024, after a career at Goldman Sachs. Next year, however, she will be in a more prominent position to advance those views. The Fed's Federal Open Market Committee FOMC sets interest rate policy. Among its 12 voting members are 4 of the Fed's 11 district presidents who serve rotating one-year terms. In 2026, the head of the Cleveland Fed, Hammack, will join that voting group. My base case is that we can stay here with rates for some period of time, until we get clearer evidence that either inflation is coming back down to target or the employment side is weakening more materially. Hammack told the WSJ over the weekend. I take it with a grain of salt, said Hammack of last week's November Consumer Price Report, which showed a shocking decline in the headline rate of inflation to 2.7% from 3.1%, with a similar drop for the core rate. Hammack blamed data distortions due to last fall's government shutdown, and her own calculation puts the rate at more like the 2.9% or 3.0% that economists had previously forecast. All things being equal, easier central bank monetary policy is assumed to be good for risk assets like stocks, commodities, and Bitcoin BTC $87,464. While that's surely been the case this year for stocks and commodities like gold and silver, all of whom are at or near record highs, Bitcoin has struggled, beginning a tumble from its own all-time record not long after the Fed's first rate cut in September. A big break with Waller. Among the finalists to be President Trump's pick for the next Fed chair is current Fed Governor Chris Waller. Waller 3 days ago said he judges the current 3.5%-3.75% level of the Fed funds rate range as 50 to 100 basis points above the neutral level, meaning Fed policy remains fairly restrictive. Hamack, though, told the WSJ that the Fed funds range today is a little bit below the neutral rate, meaning she thinks current policy is at least somewhat stimulative. That's a massively wide delta between two of $2026 as key policy setters. Wherever rates go in $2026, there are sure to be dissents on what is typically a unanimous or near unanimous vote. Whoever ends up Fed chair could find it problematic to line up the 7 votes needed at each meeting to set policy. Tom Lee responds to controversy surrounding Fundstrat's differing Bitcoin outlooks. By Siamak Masnevi, AI Boost. Tom Lee weighed in after ex-users questioned whether Fundstrat analysts were contradicting each other on Bitcoin, pointing to differences in role, timing and risk management. Ex-users flagged what appeared to be conflicting Bitcoin outlooks from Fundstrat's Tom Lee and Sean Farrell. Lee endorsed a post arguing the views reflect different mandates and time horizons, not internal disagreement. The episode highlights how public commentary can blur distinctions between short-term risk management and long-term macro views. A debate on X over whether Fundstrat analysts are sending mixed signals on Bitcoin intensified over the weekend, prompting a response from the firm's co-founder that appear to endorse a more nuanced explanation of the differing views. The discussion began after an ex-user known as Heisenberg at Mr. Derivatives shared screenshots that he said showed contrasting outlooks from Fundstrat's leadership. One highlighted comment attributed to Sean Farrell, Fundstrat's head of digital asset strategy, outlines a base case in which Bitcoin could retrace toward the $60,000, $65,000 range in the first half of 2026. Another pointed to Lee's recent public comments suggesting Bitcoin could make new all-time highs, potentially as soon as early 2026. The juxtaposition quickly gained traction on X, with users questioning whether Fundstrat was contradicting itself or offering unclear guidance to clients. That framing drew a detailed response from another ex-user, Cashin at Convex Dispatch, who said he was a Fundstrat client and argued the debate was misleading. Cashin wrote that the firm's senior figures operate with different mandates rather than a single unified forecast, distinguishing between long-term macro views, portfolio-level risk management and technical analysis. According to the post, Farrell's comments reflect a defensive positioning framework focused on drawdown risk, flows and cost bases, rather than a long-term bearish thesis on Bitcoin. Cashin said Farrell had reduced crypto exposure within Fundstrat's model portfolio as a risk management decision, while remaining constructive on longer-term adoption trends beyond early 2026. Lee's role, by contrast, was described as more focused on macro liquidity cycles and structural shifts in markets, including the idea that institutional adoption and exchange-traded products are changing Bitcoin's historical